Hi, Paul Gerard from Price Accounting Services, back again for another video in our business and entity tax matters channel, and this time we're going to talk about superannuation guarantee. Okay, since 1994, all employers have had an obligation to pay a minimum level of super each quarter for employees. This is generally based upon a proportion of the ordinary time earnings of that employer as a minimum. Then with other issues like salary sacrifice, there may be a maximum amount based upon a concessional cap which applies to the employee. Failure for the employer to pay raises an automatic liability for what is called the Superannuation Guarantee charge, which the SGC charge includes penalties, so administration fee, and backdated very harsh interest on a late payment or a failure to pay super. So, and in addition to that, the employer loses tax deductibility. The timing for this event is 28 days after the end of each quarter as a minimum. So paying your super 35 days after the end of the quarter raises an SGC liability. It might be reduced by later making the payment, but think of it this way: the payment of the super is now not deductible, and the interest and other costs should become a liability. Now, if you're worried about super, you should be. The Fair Work Commission and even the High Court decisions consider unpaid super as theft of wages, not just mere delays, not a temporary arrangement, theft. Tax laws also contain provisions called directors' penalty notices, which allow the ATO to impose a joint, individual and several liability to pay SGC for a company or trustee failure to pay the super. Liquidations don't generally end this liability. It remains a personal liability of a past director and will typically be a matter a liquidator will consider in its report and how it determines total final liabilities. With the development of single-touch payroll in recent years, the ATO has refined its data gathering detection methods. Sophisticated but simple data gathering now track each employer's super accrual at the time of pay that goes to each employee. The ATO can also see actual receipts through clearinghouses into super funds and year-end reporting for those which may not be fully compliant. So the ATO maintains notional tracking of unpaid and accrued super. This can even be seen on employee login through MyGov accounts at the ATO. Navigate to the superannuation menu, concessional contributions, and for STP-based employees, you can see your most recent pay. You can see the amount of super applicable to that pay. So the ATO are tracking it and monitoring it. Recent media, just in May of 2022, has indicated that the ATO has acknowledged they are issuing over 40 director penalty notices every day, and it's increasing. So they take it seriously. They have come under a lot of flack from various parties who have tried to chase unpaid super in the past. Now they are chasing it. They are pursuing it. And if you're an employer who's not paying, you need to be afraid. You should seek tax advice about the matter ASAP. You can correct it. It's not necessarily pleasant, but it dissolves the risk of a knock on the door with that notice being served on each director to personally pay the sum, which can be enforced by any court in the land. We're often asked or told by clients that they are self-employed and don't want to pay super. Fine. That's an option only for a sole trader or maybe a partner in a partnership where they don't have that obligation to pay minimum SGC amounts. but it also may be very short-sighted for those who are liable, such as directors or employees of small family companies or trusts. I say employees, not trust beneficiaries, employees. Working within your own company is no different to an arm's length employer, according to the courts and the ATO. We often hear this from contractors with personal services income. Sorry, but it remains a legal obligation for the company. It's not removed because it's personal services income. There are some limited exceptions, however. Trading trusts which don't pay salary and wages but only pay distributions of trust income to beneficiaries aren't obliged to pay super. Sole traders and partners in partnership are also accepted because they're considered to be producing their own income. However, also bear in mind the benefit of long-term compound growth and low tax on super. For partners in partnership and sole traders, making a super contribution can be tax deductible, which can reduce taxable income. So marginal tax saving might be as high as 32% overall if we consider the top marginal rate of 47%, reduced by the 15% tax that a fund deducts on concessional contributions. 32% is a significant saving on $27,500 a year, and when compounded continually, when earning decent returns in a fund, and only ever subject to 15% tax as a maximum, you can accumulate and grow so your super is far above your peers when you reach retirement age. Just because you might have property doesn't mean you're not comparing yourself and your wealth to your peers. People say, well, I've got some property and I'm going to retire. Well, that's good, well done. However, having more super than the other person sets you in a far better financial position. Do you remember when a can of beer cost 70 cents? Do you remember when a pizza at Pizza Hut cost $1.10? That's a family-sized pizza. The beer that you washed it down with costs 15 cents. These days, what would that cost? 20 bucks, 25 bucks for a pizza? And what would beer served in a reasonable place be? $5, $7, $8? So costs rise. Costs have risen far more than incomes have risen in recent years. So there are merits to having as much super as possible. And it avoids an age pension. We often see people who have claimed to have small businesses and they never quite get around to superannuation savings. They end up retiring or losing their business and they have nothing. They must rely on the age pension. $22,000 a year. It's not a lot of money. Alternatively, by having super, which might be $500,000 or $1 million, you have a more comfortable retirement. Even on the very minimum pension drawdown of 4% of $1 million, it's $40,000. And guess what? If you're age 60 plus, you don't pay any tax. So, super's important. And, as I said, super contributions can be tax deductible. So, save tax on the way through. Very effective. One strategy some small businesses sometimes forget is how you can actually use super to fund your business. What do I mean by that? It doesn't mean you can pull money out and use it to fund cash flow. No, you can't do that. But if you maximise super contributions between yourself and your spouse when you operate a small business, let's say that amount is just over $50,000 of additional savings into super every year. It doesn't take long before your accumulation of super is at a sufficient scale to consider perhaps an SMSF. The SMSF could have the flexibility and freedom to invest in, for example, property, such as business premises, and lease that to the business. So, win-win. You get the growth, you get the cash flows from the business, and here's the biggest one of the lot. It's asset protected. If the business folds, the worst situation is that the premises have a lease which will not be paid. The fund merely finds a new tenant and moves on. There's no loss. Whereas reinvesting the money in the business itself exposes it to risk and loss. Some people see their own business as their nest egg, as their super. However, later in life, it may fold. We've seen many examples with franchises in this situation. Reputable franchises that fold and fail because of cash flow, because of COVID, because of flooding, because of all sorts of reasons. If the premises and the business are separately owned, you may be better off. So my message here might be, for those that aren't but could be using super, consider having a discussion, not with a friend that might give you a unbalanced and unknown opinion, but discuss it with your accountant or a financial savvy person and consider the merits of long-term growth using some super. I'm not suggesting you commit all your money, all your cash flow to that at all. But if you have the profits available, it's a very sound strategy. So I hope you found this video on the issues surrounding superannuation guarantee helpful. There's certainly grounds for discussion for some, and if your business isn't complying with super obligations, it's time to have a chat with your tax advisor and say, how do I fix it? Okay, it's very straightforward. You will sleep better at night knowing it's fixed. I've had a few clients in that situation where we've had to shake the tree and say, you've got to fix it, because it puts us at jeopardy if we don't raise it with them. So, hope you found that helpful, and for this video that comes to an end, and we say thanks for watching, and hope you watch another one of these videos either in this channel or one of our others. So, bye for now.